In this week's video, we'll review the latest charts to help us answer the question, is the bearish case for stocks being overstated? It's a daily chart of the S&P 500 index beginning in October of 2006. Simple 50-day moving average in blue, 150-day in green. Simple 200-day moving average shown in red. Let's step forward through the peaking process, 2006, 2007. If you know your market history, you know the S&P 500 peaked in October of 2007. There's a lot of information on the screen here, but let's hit some of the highlights. Notice how the 150-day moving average and the 200-day moving average here, where my cursor is, this highlighted area, how close they are together. That's a convergence of the trends, telling you to pay closer attention. Similar situation here, except all three moving averages are converging in this area here before the S&P 500 peaks. After it peaks, all three of them converging. Now we have two of the three with their slopes down. This here looks quite a bit different than what we have over here. Also noteworthy, slope of the 50-day here, flattish here, price going above and below the 50-day, a lot of indecisiveness. 50-day rolls over here, then turns back up shortly thereafter. And after the peak here, notice how the 50-day makes a discernible lower high here relative to this high here. And then this breakout quickly morphs into a failed breakout look. And soon thereafter, our moving averages look very, very unhealthy and concerning. None of this is magical. It all speaks to probabilities. Notice here, we hold above the 200-day moving average. Here, we eventually make a stand near an upward sloping 200-day in red. Not the case here. This is a firm intraday rejection at the 200-day moving average. Also noteworthy, we're rejected at a downward sloping 200-day moving average. This here looks quite a bit different than this here. We can treat the 50-day just like price, just as this lower high was relevant in relation to this high here. The fact that the 50-day in blue down here can't retake the 150-day in green, it's all relevant. None of it's magical. It all speaks to probabilities. It's pretty clear to see, though. The chart looks quite a bit different over here than it does over here. So this is the peaking process in 2006 to 2008. The peak comes in October of 2007. And then the S&P 500 falls approximately 50% from this point here. Doesn't bottom until March 9th of 2009. How about the dot-com bust? The first thing that jumps off the page is the volatility. Same 50-day, 150-day, and 200-day moving average. Notice our moving averages are converging here, the 150-day and 200-day, telling us to pay closer attention. Same thing in here. Same thing in here. Gets even more concerning here where my cursor is. Why? Because the slopes are now rolling over and we get a bearish crossover here and we get bearish moves here. Here the 50-day makes a stand near the other moving averages, makes a stand above the 150-day here. That looks quite a bit different than what happens to the 50-day over here. At this point, we have a full-bore bullish look with price above all of the moving averages. Blue, the fastest moving averages on top. Red, the slowest moving averages on the bottom, and the slopes of all three of them are up. Over here, the polar opposite. Blue, the fastest moving averages on the bottom. Red, the slowest moving average is on the top, and the slopes of all three of them have now rolled over. Here, instead of making a stand near an upward sloping 200-day, we're rejected, and here we're solidly rejected at the 50-day moving average, and the slope of the 50-day is concerning, rejected again in here. So this chart is 1999 here to the year 2000 here. Let's go back to the 2006 to 2008 chart that we reviewed previously, but this time let's ask a question, and let's answer it as well. In the year prior to the October 2007 peak, how many times did the S&P 500 close below the 150-day moving average, which is shown in green? So if we're looking backwards 1 year from this peak, the answer is 26 times. And most of them occur in this area here where my cursor's moving around. How about in the 1999 to 2000 case? In the year prior to the March 2000 peak, how many times did the S&P 500 close below that same 150-day moving average? Answer, 44 times. Now, why is all of this relevant? It speaks to volatility. It speaks to indecisiveness. This occurred before this peak here. The fact that we had numerous closes below the green 150-day moving average tells you over here, there are already market participants that are concerned about what's going to happen on the other side of this peak. So in the financial crisis case, 26 times. .com case, 44 times. How about the 2022 case? In the past year, how many times did the S&P 500 close below the 150-day moving average? Answer, 0. Chart looks much, much better. And if we look at the same chart, and really now just focus in on price alone and compare it to the volatility and relatively large amplitude swings that we have in here near the peak in 2007. We do have some indecisiveness in here, but this is much more contained. Notice how all of it thus far is taking place. For the most part, price action has been above an upward sloping 50-day moving average. Contrast that with the fact that we're touching the 150-day back here, touching the 200-day here numerous times before the major peak, and then soon thereafter. Present day really doesn't look anything like that. What does that tell us? It tells us the present day trend is still quite a bit stronger than this period here, and we can make the same argument relative to the peaking process in 1999-2000. This point over here, this is 1 year before the market peaks here. So compare this look in here, looking backwards 1 year in the present day. We're in January of 2022. This is 1 year looking backwards. Just look at the slope of price. If we draw a line across here, if we draw a line from here to here, look at the slope of it. Notice how the slope, relatively mild in here. This is your peaking process. We have a lot of sideways movement. We can draw a line here in early 2007 and hit price a year later in early 2008. If we try to draw that same line in the present day, we go back less than 3 months. This is the S&P 500 after the big drop on Thursday, January 13th. The S&P 500 dropped approximately 67 or 68 points during Thursday's session. But notice how strong this trend is here. Not only have we not touched the 200-day moving average, we really haven't done anything with the 150-day moving average. And that's good news because the trend is strong. The bad news is we all know that eventually price is going to come back to the 200-day moving average. That's inevitable. So it's fair to say the chart in front of us this week shows a strong bullish trend. The last thing price did was make a new all-time high. We haven't even undercut the low in mid-December, haven't undercut the low in early December. We're really nowhere near making a relatively significant lower low by undercutting the October low here where my cursor is. And all of that may happen very, very soon. There's no question that this is a more vulnerable look in here where my cursor's moving around relative to this incredibly strong look in here. So this is the market itself. How about growth stocks? They look a little bit more vulnerable, but we still have a strong bullish trend. Still haven't undercut this October low, although we're getting close to it. This is a little bit of a warning flag here, no question. This is the first time we've tagged the 200-day moving average on this entire chart. But look at this chart here relative to this chart here and this chart here. This is growth stocks. How about tech stocks? And as always, the commentary in this week's video is based on the charts in front of us. This chart is as of the close on Thursday, January 13th. I'm not trying to predict what this chart's going to look like tomorrow, but we can make very, very confident statements about the chart in front of us. This is still a strong uptrend. Is it subject to change? Absolutely, positively, yes. Is it possible it may change very, very soon? Absolutely, positively, yes. Has it changed yet? Absolutely, positively, no. That's why we take it day by day with that flexible, unbiased, and open mind. How about the NASDAQ 100? It may be a little bit of a blend. Growth probably looks the weakest of the three. Tech looks the strongest. And the NASDAQ 100 is somewhere in between. Now, is it possible for the market to start peaking from a strong profile? Yes, it's possible. But typically, if you plunge through when you have a strong trend, hot knife through butter, that's usually a relatively short duration in days, weeks, or months correction that's followed by a higher high. Typically, longer duration bear markets have this kind of rollover look to them. Was the trend strong in the year 2000 on this chart? It was. It was stronger than it was today. It was extended, but it was very, very strong, and the chart looked healthy. But before things started to get really, really bad, a few things did happen. First, price dropped below both the 150-day and the 200-day, and at some point really stayed below it. The slopes of both of them rolled over, and we had a bearish moving average crossover. Green below red. All of that may happen very, very soon. We just don't have it yet. So let's link back to the chart of the S&P 500 and zoom in a little closer. A lot of gaps in this area down here. Even a gap that has been filled doesn't necessarily mean if it was relevant before and there was a lot of trading activity in this area, it's very, very possible it's going to be relevant again. Think of it this way. Was 4,500 right here relevant on this retest? It was. It's also possible psychologically 4,500 could be important on the way down as well. That doesn't mean it's going to hold. If the market comes down in this area here hypothetically and holds, we learn something. If it blows right through this area, we learn something as well. That's why we refer to them as reference points. Had a lot of gap ups right here where my cursor is in early to mid-October. That's another reference point. Notice that comes in right around the upward sloping 200-day moving average in red over here. Also noteworthy, it's not abnormal, even within the context of a strong bullish trend. In fact, it's relatively normal for the S&P 500 to have roughly a 10% drawdown intra-year, even in years that are green. A 10% drawdown from the highest closing high up here would take you down to 43.16. Again, somewhere in the neighborhood of an upward sloping 200-day moving average. If we hold down here, we would learn something. If we move into this area here, we would learn something, and the longer we stay there, the more relevant it would become. We're not forecasting anything here, not even forecasting that we're going to come back to these points. But we do see enough weakness up here where it makes sense to understand where these reference points are, because it is possible we could move down here in relatively short order. Just see how it plays out. Covered these charts many times, covered this in November. This chart in the center is the S&P 500 dated November 26th of last year. You may remember the 50-day simple moving averages in blue all the way out to the 250-day simple moving average in silver. How much damage have we seen on the present day chart? Considering price is still hanging around the 50-day moving average here in blue, and the slopes of all of the moving averages are up, and there's really not a lot of volatility inside of the moving average band. Once again, we have a more vulnerable look. We have a trend that looks like it's starting to wane a little bit, but this is still unequivocally a strong long-term bullish trend. Again, that's based on the chart in front of us. No assumptions about what tomorrow looks like. How about the 10-month moving average that we've covered in the past? This is what a really, really strong trend looks like in the S&P 500. You really don't even get a monthly close below that upward sloping 10-month moving average in blue. Get a little bit of a yellow flag here. Several yellow flags here because price is starting to congregate near that 10-month moving average. And shortly after the peak, if you know your market history, you know the market peaked, the S&P 500 peaked in March, but it really started to accelerate to the downside in September of that year. And soon thereafter, in calendar year 2000, in Q4, we get a close below the 10-month moving average in blue here, and it rolls over. Similar situation here. The market peaks, financial crisis bear market, in October of 2007, and you can see here we're still in calendar year 2007 and we're below it and it rolls over. This and this look quite a bit different than this and this and here. If we zoom in on this area here, you can see this is what a really, really strong trend looks like. How does the same chart look today after the big drop on Thursday? Have we pierced through the 10-month moving average? Is the 10-month moving average rolling over? All of that may happen very, very soon, but it hasn't happened yet. 10-month moving average, intra-month 44.50. The close on Thursday, January 13th was 46.59. So a drop down to this level here would be pretty painful, but it wouldn't be particularly abnormal, even in the context of a very, very strong secular trend. So another guidepost would be the 10-month moving average, somewhere in the neighborhood of 44.50. The 200-day moving average, 44.17 and change. If we round it up, it's 44.18. That's off a daily chart. And remember, we showed that 10% correction on the daily chart, the brown horizontal line. That's 43.16. All of these are simply reference points, and all of them are still below. How about tech versus value? Inflation, interest rates, and the Fed causing a lot of this indecisiveness in here. You can make an argument that this period of consolidation back here, 2018, 2019, this bullish breakout here where my cursor is, and this retracement down to about the 50% retracement of this A to B move. So we get a breakout, a false breakout, we pull back to roughly the 50% retracement, and then resume the bullish trend. Based on the chart in front of us, that unquestionably looks more vulnerable over here than it did over here, make an argument this is a very, very similar setup. We get a breakout here, a failed breakout look in here. We pull back to the 50% retracement, which is also near this upward sloping trend line. We held here, we held above it here, we held above it here, we held above it here. Doesn't mean we're going to hold here, it's simply a reference point. This is roughly the 50% retracement of this A to B move. So this is point A, this is point B, down here, point A, point B. So this is tech relative to value. We got a similar situation here with value relative to growth. Nothing's really changed here. This whipsaw extravaganza has been going on since May of 2020. Now, it's very, very possible that this consolidation is foreshadowing a bullish breakout in this direction. But right now, the ratio is still below where it was in May of last year. It's still below where it was in March of last year. And it's still below where it was in May of 2020. And the 200-day moving average for the ratio is still really slanting downward here against value. Value's having a nice push off of this low here, and this does look strong. Very, very possible we will get a bullish breakout. If interest rates are rising, typically energy and banks tend to do well, and that would be good for value in general. And typically higher rates tend to be a drag on higher multiple growth companies. And on this tech versus value chart, we also have to keep in mind, even if the 50% retracement doesn't hold, or the 61.8, or this trend line doesn't hold, we still wouldn't necessarily have a winner if the ratio moves into this area here, this white space, because we're in a consolidation box that goes all the way back to June of 2020 over here. In this case, the resolution was to the upside. Very, very possible with the Fed changing course that it's possible that we could get a resolution to the downside. We'll just have to see how it plays out. We talked about this in last week's video. You have to be very, very careful when the Fed interest rates and inflation are what are causing this bout of indecisiveness in here. There hasn't been a clear trend as far as rotation goes. So the market rotated to tech, then it rotated to value, then it rotated back to tech, now it's rotating back to value. We're still inside of this consolidation box. And if it's tied to interest rates, might make sense to look at 2004 and see what we can learn. If you're watching on a phone, I'll read this to you. It's a tweet. It says, if you are a trend follower, you are not going to like these charts. Okay, we're going to have the same 50-day in blue, 150-day in green, and eventually when we step forward, the 200-day simple moving average in red will appear as well. This is the S&P 500. Here's a peak here, Q1, March of 2004. It's been very, very easy to get whipsawed in here. Take defensive action, get back in, take defensive action, get back in, take defensive action. There's no question. In the shorter term to the intermediate term, for several months, this is a very, very difficult market. The drawdown from this intraday peak here at point A to the intraday low at point B in the S&P 500 index was 8.81%. And there's no question, we have a lot of concerning things on this chart here. This is a vulnerable looking stock market, and that's why we're covering it. Nothing magical about trends or moving averages. But if you got 2-2 bearish here, the rest of the year wasn't a lot of fun for you, because from this low here at point B, the S&P 500 rallied 14.25%, and after all of this mess over here, the annual gain between point A on the left side of the chart, over here on the right side, between A and B, almost 9%. Why is all of this relevant? Because in 2004, interest rates were a big part of all of this here. The Fed started hiking rates in June of that year. Thus, the market knows, for the most part, this is coming in Q1. And look what happens. There's 5 rate hikes between June of 2004 and year end. And you can make an argument here. The market is looking ahead. All of this is happening in here before the first rate hike. And then the bottom comes, and the Fed is still hiking rates. So the market, once again, is looking ahead. Here are the moves in the S&P 500. And notice in here, as the market gets more vulnerable, and there's no question the market's vulnerable down here. This is a concerning look down here. The 50-day's been falling for 1, 2, 3, 4 months plus in here. The 150-day, when price is down here, is flattening out and rolling over. And price has touched the 200-day several times in recent months. So if this is a really vulnerable look down here, we should keep in mind that this really doesn't look anything like the S&P 500 on January 13th, 2022. If you go back and you look at this chart, there are some similarities between this peaking process, this major peak right in here, and this point here. So it's good to keep in mind, it's not unusual for strong bullish trends to come back to an upward sloping 200-day moving average. The key is this should almost act as a magnet. Price should not stray from it too far. If it does, that looks like the COVID hot knife through butter situation. You learn something. But you can see in this case, relatively soon, the S&P 500 found buying support down here. And notice during this entire episode, the 200-day moving average in here, for the most part, is still upward sloping. When price moves off of this low here, the 50-day starts to turn back up. This is very encouraging in here. And then this bullish moving average crossover is encouraging. And then within weeks, months in here, we go back to a full bore bullish look. Purpose of these videos is not to claim that any of this is easy. That's why we use the weight of the evidence. Taking into account everything when price is down here, and you're taking everything into account when price is in this area here. So the moral of the story for us, based on our approach and our time frame, we have to be very, very careful about whipsaws and indecisiveness in a period where the market is concerned about Fed policy and interest rates. It's difficult to say that the profile in front of us here is similar to the profile on January 13th. Last week, we talked about realistic expectations. Remember last week, we said the average intra-year drawdown between 1989 and 1999 was almost 10%. The median drawdown, about 8%. Here's an 8% drawdown here. And when this is the topic, we just have to be very, very careful about overtrading. So even in the present day, drawdowns are 100% normal and to be expected. So if we experienced, let's say, a 4 to 15% drawdown from the highest close here in early January, which really wouldn't be particularly abnormal relative to a secular trend, hypothetically, this is what that might look like. This is a 10% drawdown here. Price would go below, hypothetically, if we fell straight down, below an upward sloping 200-day in red. This is a 15% drawdown here where my cursor is from the highest close up here. History says even if we come back to the 200-day, it wouldn't be shocking if the S&P 500 found buying support at least the first time that it comes down. Why are we saying that? Because we really haven't even tested it recently. As always, we're not making any assumptions about anything. This is what we have today. One of our primary concerns is inflation. It's the Fidelity chart that we've covered in the past. Here's the Twitter handle where my cursor is. We remain firmly in inflation boom territory. And it's possible that with easier comparisons coming as the year wears on, that inflation data could get less bad. In this scatter plot here, this is the present year. Here's the current reading. This is a daily DeMark chart of the NASDAQ 100 futures. DeMark charts and indicators are proprietary tools from Market Studies, LLC. This segment of the video is being recorded a little bit before 3 p.m. Eastern Time on Friday, January 14th. There's plenty of negativity out there about the tech sector. Thus, if we're going to keep that all-important, flexible, unbiased, and open mind, it might be helpful to have some information that helps us keep an open mind about better than expected outcomes. There's a lot going on here. We'll walk through it. This blue line here where my cursor is a TDST level. The fact that it's a solid line tells us that it has a qualified bullish break, telling us from a probability perspective at this point here, the trend in the NASDAQ futures was confirmed to be a bullish trend. Here's another qualified bullish break here in the rear view mirror. You'll notice none of the TDST levels that are red, these are bearish levels, are qualified. So it's possible that this area here, and this area here, and this area here, which are both below the October low, all of that could act as potential support if we see further weakness. These red diamonds here and these teal diamonds up here are another proprietary tool from DeMark. This area down here in the NASDAQ 100 futures, sitting somewhere around 15,255-ish. This is potential support. And this is a magnet up here, a potential upside target. Hypothetically, if the NASDAQ 100 futures were to right themselves and we were to move from this area down here up to this area here, 17,052 where my cursor is, that's a gain from here to here, somewhere in the neighborhood of 10 to 12%. It's not a prediction, it speaks to probabilities. It's very, very difficult to say that the technology ETF chart that we covered earlier in the video doesn't support the concept of keeping an open mind about the bullish trend that's obviously still in place continuing. Again, none of that's a prediction, just offsets some of the bearish narratives that are floating around related to tech stocks and the NASDAQ. Let's recap some of the key points. Odds do favor bigger drawdowns in calendar year 2022 relative to 2021. Market history tells us that even within the context of a strong secular trend, an 8% to 15% intra-year drawdown is really not abnormal, it's normal. And really the significance of a trend that still looks strong, a strong trend has a higher probability of eventually going on to make higher highs. A weaker trend has a higher probability of making a series of lower lows. And relative to this question here, the charts that we've covered in this week's video, they speak for themselves. The Fed has stated that they may raise interest rates as many as 3 times this year. Some believe it'll be 4. That's in the to be determined category. However, that uncertainty around Fed policy, interest rates, and future inflation readings tell us it could be very, very difficult to navigate between January 1st of 2022 and December 31st of 2022. There could be a lot of noise in between, a lot of false starts, and a lot of whipsaws. And the chart here doesn't even include the type of whipsaws that can take place in terms of rotation between sectors and rotation between value and growth. We have to assess the probability. Trading in this window here where my cursor's moving around in the lower left-hand corner of the screen, if we're trading frequently in here, under this scenario, what are the odds that that type of trading is going to add value or destroy value? By no means are we saying this is what 2022 is going to look like, but we do know we have a similar setup relative to the Fed and interest rates. Not trying to make the case that 2004 is identical to 2022. We all know that's not the case. And we all know the only way any of this works, if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.